Thanks for clicking. US Treasury yields plummeted downward yesterday after it was announced that the US Treasury was changing the way it borrowed money, shifting more of its debt needs to that of the short term. The yields on Canada's 5-year government bonds, the yields which dictate mortgage rates, followed soon thereafter, falling below 4% for the first time since mid-September.
I knew this was going to happen.
And while, as we'll see, it's still unclear if this drop in yields, this drop in borrowing costs, will hold, the sharp drop in the market, brought on by what is usually a fairly mundane announcement coming from the US Treasury Department, demonstrates the importance of US debt costs for Canadians going forward. Given that Bank of Canada Governor Tiff Macklem noted just yesterday that the wave of mortgage renewals at higher mortgage rates allowed the Bank of Canada to hold on rates at its last announcement, this is definitely a salient issue. So what I want to do today is go over yesterday's refunding announcement by the US Treasury, discuss how and why yields fell so far, go over the implications for Canada's mortgage market, and then discuss what to look for next. Speaking of next, it is a new month, and we are eagerly awaiting the release of October's real estate data coming out from the local boards any day now, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into US debt costs. On to the Treasury announcement. So, what happened? The United States was set to make its quarterly announcement on how it was going to borrow the money it needs.
Give me the money.
Not exactly. The US was set to announce how many and what types of bonds it was going to issue to cover its ever-burgeoning debt. The statement from the Treasury was set to arrive after Monday's announcement that the US was going to be borrowing $776 billion in the fourth quarter of this year, the highest it's ever borrowed in the fourth quarter. Monday's announcement led some to worry that US 10-year Treasury yields, the amount of interest US pays on 10-year debt, could pop well over 5% again. But that didn't happen. Instead, immediately following the announcement from the Treasury, yields on 10 years dropped by 11 basis points, and yields on 30-year Treasuries dropped as well. And the reason for the drops in yields is that the US is going with a variable rate.
Yes!
Again, not exactly. The US announced that it's going to be borrowing short, relying more on shorter-term bonds rather than long-term bonds to fund its deficit. Coincidentally, borrowing short via fixed rates is what is actually examined in that study that the mortgage industry cites but doesn't read. Regardless, as we've talked about so many times on this channel, US borrowing costs have been surging, and so too have Canada's, as there just hasn't been as much demand for longer-term US debt, given the U.S. fiscal deterioration. In fact, during an appearance before the Senate yesterday, Bank of Canada Governor Tiff Macklem even mentioned the problems that the U.S. is having issuing longer-term debt.
The long-term markets wants to be compensated for the risks that need to be taken. Deficits in the U.S. are 6 or 7%, and it's not clear that these will go down. And some bond buyers, American bond buyers, have probably decreased their purchases.
But yesterday's announcement that the U.S. was going to be issuing relatively more short-term debt rather than long-term debt, leaning on 2, 3, and 5-year bonds rather than 10 and 30-year bonds, means that there won't be as much of a supply of long-term U.S. debt coming to the market. And when supply decreases, all things being equal, the price increases. And since yields and prices are inversely related, yields on long-term U.S. debt went down. And if it holds, mortgage rates may follow. For its part, Barclays noted that the move was probably welcomed by investors who had struggled to absorb the amount of U.S. debt coming to the market. And it makes sense that investors would be more willing to take on 2, 3, and 5-year debt from the U.S. than they would be to take on 10 and 30-year debt. Lending someone money for 2 or 3 years is much less risky than lending them money for 30. So, the U.S. is going to rely more heavily on the shorter-term bond market rather than the longer-term market. Yields went down. We're all set, right? That does appear to be the case, according to Jim Cramer, who said that the U.S. may indeed have found a way to stabilize the bond market.
We're all
Bear Stearns is fine. Do not take your money out.
Seriously, there's actually an inverse Cramer ETF where you can buy stocks that bet against anything that Jim Cramer predicts. But that's not really here nor there. But is everything actually fine now? Can the U.S. just rely on short-term debt issuance, keeping a lid on longer-term yields, and keeping a lid on mortgage rates?
Of course they can.
Well, let's be very clear as to what this actually is. Demand for long-term U.S. debt is so low due to the U.S. financial position. with former Treasury Secretary Larry Summers saying that the US debt is a more serious problem than ever before. Investors don't want to commit to lending the US money for 10, 20, or 30 years at current rates due to its precarious financial position, to say the least. As such, the US is saying, well, just lend us money at 2, 3, and 5 years, and after that we'll refinance and see what happens, to which investors are expected to agree. With that said, given the weak demand that we've seen at previous Treasury auctions for even the 2 years, it's still not clear as of right now as though that will be the case. So we don't even know, right now at least, whether or not this plan will work. The US is betting, the US is hoping, that interest rates will be much lower in 2, 3, or 5 years from now, and at that time, they'll be able to refinance at a lower rate.
Isn't that a Ponzi scheme, bro?
But that's definitely a big bet going forward, given that the US is expected to add another $5 to $6 trillion in debt over the next 2 to 3 years alone. Regardless of the long-term consequences for the US economy, however, yesterday's move sent the yield on the 5-year government bonds plummeting below 4%. If this holds, if this keeps up, we might see some relief on 5-year fixed rates, now sitting close to 6% for a decent 5-year fixed. So, short term, this move by the US Treasury could put downward pressure on Canada's mortgage rates. Long term, maybe not so much. B lenders, in general, only lend for 1, 2, or 3 year terms. A lenders lend for 5 years. And the reason is that B lenders are more cautious. They want to see how you do. The US having to resort to short-term financing that has to be refinanced in 2, 3, 5 years' time, is definitely not the marker of financial stability. It's definitely not the marker of a borrower who has the confidence of its lenders. With that said, whether or not there will be the anticipated demand for short-term US debt remains to be seen, but we'll obviously continue to track that on this channel and its effects on the Canadian market. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.